So I want to welcome everyone today. Today we are going to talk about tax efficient investment growth for children using life insurance. Can you hear me? I said today we are going to focus on building wealth and a lasting legacy for children through tax efficient investment strategies. So I say good morning, team members, those watching from the live view, and those watching from their homes, depending on the timing, depending on our time. And that's why I said good morning. I'm not sure what time it is at your end. So it's morning or evening. But I know most of us are thinking about just give me a minute. I'm having some issues here, please. So today we are going to focus on building wealth as a lasting legacy for our children through tax efficient investment strategies. So here I want to introduce myself. My name is Tosin, Ailoyafen, and I have my colleague here with me, Patrick. We actually prepared this slides together, and I hope it will be worth your time today. So I want to actually introduce a powerful concept that many families actually overlook, which is how to use life insurance as a long-term, tax-efficient investment vehicle for their children, for your children, for my children. I've already done that earlier before I became an independent broker, and you should come to understand that this is more than just insurance. As everybody thinks, just insurance. No, it's not so. It's about setting up a financial legacy that gives your child or your grandchild a head start without the heavy drag of taxes. Life insurance can actually play a crucial role in this process. If you want to look at it, just let you understand this. So Patrick and I are excited to share the insights of how to leverage life insurance for your children's financial future. We actually explore how it provides not just protection, but also as a means to grow wealth in a tax advantage way. So let's us see. Next slide to dive in to more details of this powerful tool. Slide. So imagine giving your child a financial head start. For us as independent brokers, what are we here for? To help families, not just individuals. So we see ourselves as life protectors, income protectors. And we also say that what if we could have actually give our child tax-free financial head start? What do we do? What strategies do we do? We actually dive into different strategic accounts, vehicles that we can use to say yes, we want to help our kids or want to transfer wealth or want to actually be not be overwhelmed or overburdened when it comes to their time when they're going to school or want to make some decisions, they're getting married. So we as financial advisors, we do not want to overlook the kids too. Let's see how this can actually be of a greater advantage to them because they actually are future and you must start well for them. So financial advisors out there, we're all responsible for the future. That is, we are here now and our children are coming, our grandchildren are coming. What are we putting in place for them? There's something you need to learn here from each one of us who are advisors in Canada. So going forward, when we actually think about saving for our children, what comes to our mind? Yes, the Registered Education Savings Plan, that's the RESP, the GICs or saving accounts. But remember this, but what happens to those when the market dips or interest rates actually rise? More importantly, how much of that growth do you actually get to keep after taxes? Have you thought deep about that? Today, I want to compare that to a strategy that offers growth, protection, and tax efficiency all in one. You're saving money, your money is growing, it's protecting that individual. So don't leave your children out of this. They are more of an advantage than someone who's older. Traditional saving methods like RESP, that's Registered Education Savings Plan, the GICs, the savings account, because you can actually open a savings account for your child, but you will be the one. There's a way, it's right way the bank does it. So this may actually not be sufficient to combat inflation or taxes. It's essential to consider whether your child will inherit a tax-free legacy or tax burden. Think deep about it. So don't just leverage just on these other accounts. This slide actually highlights the limitations of conventional saving strategies and emphasizes the need for more robust financial vehicle. We'll actually discuss how life insurance can fill this gap, because that's what our intention is, to fill out these gaps and provide more secure financial future for your children. Hmm? So let's educate you more about how this plan, this policy actually works. Most people actually think that life insurance is just about replacing income if someone dies. I had a client who called me as regards this and says it's not just for if someone dies. And I said there's more, because if you have a permanent life insurance, it can be a powerful living asset, especially when started early on a child. That's one of the greatest gifts one a grandparent can give to a grandchild. Very cheap. Imagine a grandparent giving a grandchild, they are born today, and they give a grandchild $25 as a gift, or maybe $1,000. But if that grandparent actually give that child a life insurance, a permanent life insurance plan, it's very low. You can get it as low as $15 for that newborn baby, as old as 14 days old. So it actually offers that low cost entry for that newborn, long life coverage, and a cash value that grows tax deferred. Meaning more of money stays working for you, you know. Now, if it's the permanent life insurance here, such as the whole life and universal life, which are the two types of permanent life insurance we have in Canada, serves as a financial vehicle that offers dual benefits, protection and tax sheltered growth too, and also in this. It's not merely a safety net for death. I keep emphasizing, it's not about just death. No. It's a long life asset that can appreciate over time. So I hope this information I've given here has helped to clarify that unique advantage. I put it a bit, I will speak more of this permanent life insurance, positioning it as a strategic choice for families looking to build wealth while ensuring that their loved ones are protected for life. Hmm? So going forward. So let's look at this now. You want to secure the life of your child early. Here is how it works. It pays out monthly or annual premiums. Monthly or annual, you can pay out actually monthly or annual premiums, depending, or you can even pay it out quarterly. A portion of it actually goes towards death benefit that is protecting the child, and the rest accumulates as the cash value. That cash grows quietly, steadily, because you're just doing it at your own convenience, no stress about it. And you can then access that cash tax-free through loans or withdrawals later in life. Hmm? This actually means that your child can use it for education and use it to purchase their first home. Can use it to start a business, anything for good. You can use the money for when you want to cash out some money out of it. So securing your child's future early is actually a smart financial move. By purchasing this life insurance, the permanent life insurance itself, as what I'm emphasizing, at a younger age, that child actually and you benefits for the lower premiums, and it's locked in with their good health. So that's when we talk about insurability, because they'll still go and check out the history of that child. Now, the longer the policy is in place, the more time one has to grow that wealth and maximize the value of it. And that's why I said for a child, they have a longer time to invest. So why waste time? Do it as early as possible. Give them that gift, that great gift of wealth. So in summary, I'm emphasizing here the importance of how early investments in life insurance as a means to ensure financial security and grow wealth for your children. Hmm? So going forward, life insurance cash value strategy. So here, The life insurance cash value strategy allows premium payments to grow tax deferred. Like I said, it creates a valuable asset over time. How does this actually? It's the cash value life insurance can be accessed through withdrawals or loans for significant expenses like tuition or down payments for a home. Like I said, most cases it's actually a way of building more assets. So when your child says, I want to withdraw money to go and buy my first house, and then do whatever he wants to do with maybe rent out to friends, and they're all paying the mortgage, the rent together, that's still building wealth. Additionally, the death benefit is actually paid out tax free to his own or her own child, that's the grandchild now, making this strategy very attractive, an attractive option for families. So we explore how this approach can provide financial flexibility and security. You get, so if you work with a good financial advisor that knows how to manage this stuff well for you, you're in safe hands. Okay, so I'll give a real example here. Hmm. So let's look at the real life example to illustrate the benefit of how this strategy works. I'm insuring a 3-year-old daughter of a family just with $100 per month because I didn't say you can't use the other um investment vehicles. You can RESP, the Registered Education Savings Plan, the JET. You want to use the now you want to diversify because diversification is actually a strategy of growing wealth. Don't overlook the permanent life insurance here. In this case, I'm using an example of a 3-year-old that was insured with $100 premiums every month. So the premiums is not the cost of insurance. So don't get it mixed up. So many people mix and say, $100 for insurance? No, get it right. There's a portion they're taking out for insurance and a portion they're taking out for savings in the fund accounts. So imagine this now, this monthly premium can actually lead to approximately 30,000 Canadian dollars in cash value by age 20 years added to that child's life. So this cash value can be used for various purposes. Like I said, nobody's going to kill you, whatever decision you want to make. You can tell the child to use it. What do you have to do for? I want to give this to you, have some money. Fund your education, that is, add more money to support your RESP, the money you have from your RESP. Maybe you're going to read any medical or physician course, any course that has to be so expensive. Support that child with that money you've also diversified in this account, this policy, and you can actually, the child can decide that I want to start a new business. There's nobody that is going to bother this child. And while also providing long life coverage, remember, it's still doing that job. And the tax-free transfer of wealth to that child. This example actually highlights the long-term advantage of early investment in life insurance. You see it. It's just that many people don't know about it. No taxes, no market risk, and the policy continues to grow for life. So that's why I said you must work with an advisor that knows how this works to guide you. This parent or grandparent that has actually ventured into this could transfer the life policy to this child, this daughter, tax free, when they've actually studied that her lifestyle is not something that they will be questioning or she has gone to lavish the money or something. Transfer it to how she's 18, seeing that she's very prudent. You educated this child from how to save and how to invest. Transfer it to her later in life from 18 years and above. They can take over these accounts while you were the owner before. I hope this clarifies your concerns. So let's now look at this. Why CRA favors this strategy? What makes this strategy so powerful? Is it its tax efficiency? Yes. The cash value grows tax deferred. Tax that is tax free. That's in you don't. It depends on how you want to withdraw the money. If you withdraw the money, close the account, then you pay taxes on it. So don't get it twisted. That's why you must understand how you want to use policy. If you want to close the account, the policy, you close it. The interest that grew on the money you put in there, that is the not your capital, the interest, then you pay taxes on it. I hope that's clear when I say tax deferred. So another way is that the death benefit is also paid out tax free. And if you don't, and going back to how you want to withdraw, if you want to strategically withdraw without paying taxes, you can actually take out policy loans. There are different ways to take out money from the policy without being taxed. But remember, it's going tax free. And when it's transferred to the next beneficiary, after it has been reviewed over years to years to years, because you are seeing your advisor year to year to see what changes are happening in that child's life or your life, you can actually decide that you want to change the beneficiary. And when it's going to happen, when life happens to that child who is now an adult, by God's grace, that lives on, it's transferred to the beneficiary tax free. So policy loans are not considered taxable income. That is when I said you want to take it out through policy loans. And then it avoids probate when structured correctly. So probate can come to play if there is no more owner. So advisors out there, remember when you're setting up this policy for kids, remember to always put two contingent owners, because if anything happens to the grandparents or the parents, then it goes into probate. As I said, you need to work with an advisor that you understands this properly to be careful, because that is the problem of probate. Okay, Canada Revenue Agency CRA favors the strategy for several reasons. The tax-deferred growth of cash value, tax-free debt benefits, and the potential for tax-free potential loans make it an appealing option. Additionally, it's structured correctly. There is no progress involved in this when you structure it properly, which can simply transfer to the beneficiary without any issues. That is a well transferred strategy without any problem in the future. I hope this clarifies again the approach is not too complex, and the beneficial and it's beneficial to those who are listening out there. Just to let you know that it must be endorsed by tax authorities. So let's go forward. Moving ahead, once we use this um, while they live, how do you use this while they live? Like I said, it's not just an inheritance. The cash value can be tapped during that child's lifetime to fund a major milestone. Can you imagine? It can be a source of funding education. That is, the child is going to university. What do you want to do? Oh, I want to actually do some certain thing in university. I want to open, let me use the word we use then in Nigeria, a talk shop, run a business while I'm still dreaming, or I want to have a lab. So it's going to cost money to that child. So you're supporting that child's dream in school. And then if the child graduates, you will decide that, okay, she has not decided what she wants to do, he has not decided. They are going to get married. You don't have to give yourself a bother because you started something long time ago and get wedded without stress. You just withdraw that money and you have money for a wedding day. Down payments for their first home. Even a business, whatever they want to do, that money can be used for it. So additionally, it can provide that financial support during their retirement. What if that child or you forgot about it? Because if you're too wealthy and you forgot that that policy was there, that child can use that strategy to retire. Imagine how much will be in that policy at the time the child is retiring at 65 or 60 or 55. So I hope this reinforces the idea that life insurance is a dynamic financial asset that can adapt to changing needs and goals over time. Hmm? So while the insured, that is your loved one, hmm, is still living, they're providing funds for education, purchasing their first loan, starting a business, or you want to supplement whatever retirement plans, I don't know. I will continue with the next slide. So once you use it as a gift, gifting this life insurance policy rather than tax building is a strategic move. Grandparents love this strategy. Those are the ones that have been knowledgeable about this on time. Instead of gifting money that could be taxed, they could fund the policy that grows silently and securely in the background. Nobody will know what's happening. It's nobody's business. It's one of the smartest intergenerational gifts available today. It's just a few know about it. Just a few. And thank God those ones as advisors tapped into this on time and we're sharing it to the world now that we can help more families out there. You came to Canada not just to waste time. You don't want because time actually works with money. So grandparents can actually, you can imagine tomorrow when we ourselves become grandparents, we have that knowledge already and we're sharing it with our clients to our prospects. That you can do this quickly. become a grandparent, use it to pay premiums. Don't just give your child the money like that. They will not even, they'll go and spend it and buy candies or whatever. I'm not saying don't give them money for candy. When you become a grandparent or a parent, you're still a parent. But you should be very intentional about the future. Those premiums at least that's being paid by you as a parent or a grandparent, effectively you're gifting a financial tool that avoids capital gains taxes on RSP and real estate. So don't just focus on all those kind of accounts. You can actually diversify to the combined life insurance. So I'm just highlighting here the advantage of using the life insurance as a means to transfer wealth and ensuring that the next generation benefits from the tax efficient legacy without the burden of taxes. Okay, so let's see what's next here. So, busting the myth. There are several myths out there surrounding life insurance that we need to address. Some people think that kids don't need life insurance. I've seen that in several WhatsApp groups, and I'll just shake my head and say, oh, alas, Umasheo. Umasheo means what a pity. But it isn't about need, it's about strategy. Now, others say it's too expensive. Like I saw another group too. So I said, and the person my friend he said, you mean 280 for a 40-year-old? That is the cost of wasting time. We pay more because we surely need it. But imagine one who has started earlier. You can start with $30, $50. But a person that knows about what he wants to do with the cash value in the future, in the next 20 years, will start with $100, 150. We diversify with wisdom and say, don't worry, I know what I'm doing. When I see those parents, I say, man, who's your advisor? I ask. But in reality, starting early locks in the lowest premiums and gives you decades of compounding growth of your money. Many believe it's only for death. I had a client, so a prospect that called me and said, "Tosin, is it just for death?" I said, "No. Some people think it's even a bad thing. Now, when you insure your child, they're going to die. It's not so. Not so. That child don't need, they'll say that child doesn't need it. Why are they doing it? Or is that expensive? But what about putting RESP 210? And I said, why are you not diversifying? Give this child this gift. You do not know today, but tomorrow you'll be thankful. In reality, hmm, life insurance is a living financial tool that can provide significant benefits. It doesn't shout. It's just a few that know about this. This slide actually I'm showing you here. The aim is to debunk these misconceptions and educate the audience who are listening out today to now on the true value of life insurance as a part of comprehensive financial strategy. You know, today, if you're listening, just tap into it quickly. So, how to set it up for your child. Setting up a life insurance policy for your child actually involves several key steps. First, you have to define that client or that owner, that one that the person that you want that needs to own the account, their financial goals. And you need a financial advisor to do that. So then you work with a licensed independent broker, like my colleagues and I that we meet every Monday to Thursdays because we mean what we are doing. We mean it. We want to help you out there to choose the right coverage and right payment plan for your family. And we don't want you to be overburdened and say, what did I put myself into? No. Finally, we also consider the future ownership and transfer options. What are your goals to? So here, we want to actually process, our aim is to actually process, making it clear that with the right guidance, establishing a life insurance policy can be straightforward and beneficial. We'll make it simple for you. Not going to be a burden. Hmm? So let us give our child more than money. As an advisor, like myself, my colleagues are out there doing the same mission to help more children because I focus on every family. If I meet the family that says, I want to put more towards my retirement, I said, why not to protect everybody in the family? And these kids are actually people you can start with on time. So as an advisor, we actually help clients to choose what fits their budgets and their long-term goals best. So this kind of policies for long-term plans, to use it for long-term plans majorly. and long-term goals. The best time to actually start was like yesterday. So if one is still wasting time, start thinking of it today. Then the second best time is actually today. Don't waste time. Now let's explore how you could build a custom tax efficient plan that protects your child and grows with them. That's what I do tell them when I meet with clients. Are you not thinking of the children? Like you can actually structure something out that will start with 20 minutes conversation, and then we'll just see how it works for them. How they and I explain our colleagues to explain how it works for them, because it's not one shoe size fits all. You have to think of how it works for the clients to that's why doing a financial analysis. So by providing your child with more than just money, you're offering them tax-free growth, financial flexibility, a lifetime coverage. Actually, this slide you see here actually escapulates the essence of my presentation, saying that you can build a legacy for your child tax-free, and it goes beyond you can imagine, depending on how you plan with your financial advisor. So my final word today is to tell you that I appreciate every one of us who are out there doing this committedly. And I want to encourage those that are just new in the profession, because this is a calling for every one of us. We are protectors of life, protectors of families, protectors of people's income. We are there to actually help you to meet your long-term, short-term goals. We don't know how you see life insurance, but we are independent insurance brokers, and we always love to protect lives. So I encourage everyone to continue to stay tuned and continue to work with a financial advisor and make sure you ask questions. Don't feel shy about, oh, just set me up. So every one of us that are here, I want to say thank you for always being there and always showing up anytime we have to educate ourselves and to improve on what we already know. So this is the end of my presentation. If you have any questions as regards what we heard today,